When we talk about PG arrays, there are various PG arrays. There are order blocks, there are fair value gaps, there are breakers, there's equilibrium, which is a combination of understanding the premium and discount, which is also a way of understanding our FIP. We'll also be talking about the FIP in one of the coming videos. We also have other PG arrays like liquidity pools. We also have the rejection block, proportion blocks, but those ones we will not really consider them. We will not want to talk about them. The video for today is going to talk about liquidity pools and how to understand liquidity pools. What is a liquidity pool, first of all? A liquidity pool is a set of highs, relatively equal highs, or relatively equal lows, which have buy stops or sell stops above or below them, depending on the level. With those buy stops and sell stops, price will have what we call external range liquidity, because external range liquidity forms in two ways, either as buy side liquidity or sell side liquidity. Buy side liquidity presents itself as sell stops, sell side liquidity will present itself as buy stops. So for example, we have a range like this. It rates down and then it heads for the highs. This level down here, this is what we call sell side liquidity. Why is it called sell side liquidity down here? Because this is where if buyers will be buying, they will have their buy stops below here. If price takes out sell side liquidity, it is heading for two things. First things first, it will be heading for internal range liquidity, which is now the order blocks, the fair value gaps that we are always talking about. And then it will head for the opposite side of the range, which is buy side liquidity. That is how liquidity will always present itself. It will now only be a matter of the range. You'll see scenarios like when price takes out the daily low, you can head for the daily high, or it takes out the weekly low, you can head for the weekly high, where we have our CRT people even talking about it, calling it the candle range theory, candle range low and candle range high. I'm not here to call anybody out, because for me what matters is you should understand the concepts. What matters is you understand what it entails and how you can trade it. It doesn't matter how you call it. It matters if you can trade it. Here we have a scenario that we have just called. A popular scenario of this is with the ASEAN range. If you look at, if maybe I turn on my ASEAN range indicator so that everybody can see, and we go down to the 30-minute chart, because my ASEAN range shows in this time frame, you will notice that most scenarios in a day, price will always go for the buy side of the ASEAN range before expanding to the sell side. Why? Because the ASEAN range is a period of rest in the market, as we all know, especially in a market like GBP USD, Euro USD, in the USD major pairs, excluding USD JPY and the Australian slash the New Zealand pairs, because those ones are kind of effective during this period. So here we have price taking out the high, rallying to the low. Some scenarios like this will always occur. It is very normal. But these are other scenarios where price heads for sell side before buy side. And then here, it finally even comes from buy side to sell side for feeding the daily profile. Here, the same scenario, price had to continue selling on this day, took out the ACR's high first of all, caused the total soup, the order block. If you go to the lower time frame, we'll have our shift in market structure. Inside of here, a 4-hour fair value gap, which price uses to sell back to these lows. You may come and clear off these lows on Monday, because at the time that I'm recording this, Saturday, the markets are closed. We also have other scenarios. We must not look at it from the ASEAN range perspective. We'll also see it from these other scenarios. If you look at it from here, looking at this here, there is, we can always say there is liquidity inside of liquidity. For me, explaining that will be kind of confusing, but it is the only way for me to say it. Price will always move from one range to another. Inside of this range here, inside of this small move here, we'll be seeing this as price has taken out external range, that is this low here, and rallied to this high, created the order block, continuous expanding till this high, and then further this high, fulfilling the market maker buy model. But if you go to the higher time frame, what will you notice on that same area? You'll notice that price taps here into a weekly bullish fair value gap and expands. What am I trying to show here? I'm trying to show that even in the scenarios that we'll see price taking out our external range liquidity in this level, which it must happen before any major move comes, there must always be that raid before any major move occurring. That move must also be tied to a higher time frame, higher time frame level of context. Some people will call them a supply zone or even a demand zone. And by those higher time frame zones of context, I'm talking about the levels of internal range liquidity, like the order blocks, like the fair value gaps. If it's that you see maybe a stop horns, if you are able to identify it up to that level, you'll be looking for your sign of strength on the 4 hour based off of a weekly PZ array. If you have a weekly PZ array or a weekly zone of context, you'll be looking at your structure on the 4 hour. If you have it on the 4 hour, you'll be looking at your structure on the 5 minute. If you have your structure on the daily chart, you'll be looking at it also on the 15 minute. If you look at it on the 4 hour, you'll be looking at it on the 15 minute. There will be other time frames that also match with it. Like sometimes you see the 4 hour and the 1 hour are also good. The 1 hour and the daily are also good. But what I'm giving is just a basic way that you can also look at the price. It is very important for you to know how to look at price, because if you know how to look at price, you'll be able to know how to frame your trade. And if you're able to frame your trade, then with proper risk management and proper execution and patience, you will be able to trade profitably. Anyways, I think we have spoken about everything for the class of today. I wish you all good luck and good trading. God bless you.